Hi, my name is Robin, and I'm the Inclusive Business Resource Network Capital Advisor. And welcome to the second video of our Startup Capital series. And in this video, we'll be talking about realistic types and uses of capital. So first, let's talk about the need for capital. Why do you need capital to launch a business? How do what types of uses are there? The first part is startup costs. Just setting up the business, getting the doors open and everything involves a bit of startup capital, the cost that you have to pay for to get forms filled, register this, et cetera, et cetera. Um, for some businesses, you need to acquire inventory or materials. If you're a retailer, you need to acquire goods that you'll be selling. If you're a manufacturer, you got to acquire raw materials that you'll be transforming and manufacturing into your finished goods. Um, Tenant improvements are another, particularly for retail type businesses. Could also be for commercial businesses that don't necessarily have a retail presence, but transforming the space that you rent into something that's suitable for your business. That's improvements, furniture, piping, HVAC type stuff. Again, things to transform your space so that you can conduct your business. That's all referred to as tenant improvements. Some businesses will need equipment and vehicles, machinery to make goods or allow you to produce some certain products. If you have delivery services or offer delivery, you'll need to kind of have vehicles or a vehicle to deliver your goods or services to your clients. There's also working capital. Working capital is kind of a type of capital that is needed just to kind of keep the day-to-day operations of your business, running. It's not necessarily earmarked for a particular item or purchase. It's just that every business does need capital to, just kind of run and operate. Another example of working capital is certain businesses. It may take them a while for your clients to pay you for the goods or services that you provide. This is very typical for like government contracts. It may take 30 to 60 days for them to, pay you, but you've incurred the cost, whether it's your employees or, goods or materials, you incur those costs up front, but it's not, 30 or 60 days until you get payment. So you need some capital to kind of bridge that time frame. And then last is just general sales and marketing. You need to tell people that you're out there, you're available, that you're in business, and if your business, requires salespeople, you need to do, or not salespeople, but if you might need to incur expenses to, generate sales. So those are, kind of typical startup capital needs. One type of capital that you can get is equity capital, and the expectations around equity capital is that it's capital from a third party. They don't, they'll inject that money, they'll give you that money in the business for your business to use. There is no expectation that those funds will be returned. However, there is an expectation that, some ownership or control of the business is given to the parties that invest in the business. But not always. There are, forms of equity capital in a form of grants in which, you're given the money, but there's no expectation that they control the business. Um, Another thing is, just share of future profits. There's an expectation for equity investors to get a share of future profits or getting a share of the proceeds when the company is sold. So an example is, let's say you, as an investor, you, the person as an investor, make a sole $20,000 investment in your business. The money goes in your business. They can be used as the business by the business as it see fits. You, the investor, have 100% ownership of the company. You, the investor, also have 100% ownership of the company. And then you get 100% of the profits or proceeds, when the company is sold. Another type of capital is debt or loan capital. And the expectations around loan or debt capital is that they expect the funds to be returned at some point in the future with interest. There is no ownership expectations. As an owner, will still get 100% of the control of the business, 100% ownership of the business, and the individuals or the parties that loan you the money do not get any control. And they don't get, typically, they do not get any share of future profits or proceeds when the company is sold. There are two kind of main types of debt capital types. One is a personal debt capital, and the loan is in the owner's name. So it's in your individual's name. And so examples of that is a credit card that you may have in your own name. It could be a personal loan that you obtain in your own name. It could be a home equity loan. If you own a home, you get a loan based upon the equity of your home. Again, that's in your own name. Or it could be even a loan from your 401k. And then when you get that loan capital, you take that money and invest that money into your business as debt or equity. The intent or the idea is that the business would generate a profit and pass those profits back to the owner, and then the owner uses those profits or proceeds to repay the loan. Another type of debt is a business loan. In this case here, the loan is in the business's name. The business generates profits and repays the loan. And if the business defaults, meaning that it can't keep up with the loan payments, the owners are still responsible for repayment. It's called a personal guarantee, and it's pretty much required for every business loan that is made, especially for small businesses. And the reality is that business loans are not really a viable option for startup capital. And we'll talk more about that in a future series video. So let's give an example here of an example involving a restaurant and how debt can be used. Let's say you are interested in opening a restaurant and you do your research, and opening a traditional brick and mortar restaurant is going to cost $100,000. That's a lot of money for a brand new business. Then you kind of scale down your ideas a little bit and say, hey, we can do a food court. A food court is still going to cost, $25,000 or more, depending on how elaborate you want your food court to be. There's another option where you can do a pop-up. That's borrow, for example, an off day at a restaurant for a percentage sale or trade or some kind of typically informal arrangement. And in this case here, there's little or no upfront capital commitment, because you're paying it off as a share of profits or a one-off or with a friend that happens to own the space. So that's a viable option for a brand new business. Or you can even start off as a side hustle, where you're cooking in your kitchen and it's a one-off meals that you prepare for friends and family, from your kitchen. So one possible way of evolving your restaurant from an idea to a brick and mortar is, start with a side hustle, right? And start it with your business at your home. And this is really to see if there's interest, with yourself for running this type of business, and if you can get customers that are interested in the food that you serve. If you're able to kind of, say, hey, this is pretty interesting, and the customers say, hey, we love your food, then it might be time to do a pop-up. You can rent or do trade with restaurant space once a week. Again, not a commitment. It's a proof of concept. You build a following, you learn lessons, you generate sales, very little capital commitment, and you get to further along your plan. When the revenues are steady and growing, you can use your savings that you may have at the time, and maybe a small personal loan to purchase a food cart. And you get the food cart, up and running. It's building a following, you're growing revenue, and as more and more revenue grows, then you're able to get or justify to a bank or to a lender to get a bigger loan and then move into a restaurant. So this is just an example. There are many different variations, but it's kind of how you can start from something, from just an idea with little capital, and then over time acquire more capital to pursue your vision. So I mentioned earlier about why business loans are limited, and there's a few reasons. One is lenders want to see proven multi-year profits. They're relying on the business to repay the loan, so they want to see profits. It's profits that repay a loan. They also want to see proven management. Just because you can, make a good widget or cook a great meal doesn't mean that you are a good business manager. So they want to see a couple of years of you running a business to make sure that, it's capable management that is, able to repay the loan. And they also, business loans will typically want to see collateral or have collateral that they can kind of acquire in the event that you can't repay a loan. And if you don't have much collateral or much assets in your business, especially for a young business, it might be a challenge to get a loan. There's another video on this new YouTube network that you can get called Can You Get a Business Loan? And I would encourage you to look at that video to see what it takes to qualify for a business loan. But I would also recommend that you just save your time and hassles. Don't aggressively pursue a business loan if you're a startup business. You're going to probably get a lot of no's for the reasons that I mentioned. It may be easier to get a personal loan, so a loan in your own name. It's not going to be significant unless you have a home equity loan or able to tap into an existing 401k. But that getting a personal loan might be a more viable option than getting a business loan. There is one exception, and that is there are some community, typically nonprofit lenders that do offer startup loans, and we'll talk about that more in a little bit. So again, that's the end of this first video. I want to thank Prosper Portland for making these video series available, and please join us in the next video. Thank you.